All right, so this morning we have some good news on the stock investing front. Turns out corporations did not cut dividends back nearly to the extent that was predicted. So dividends were only cut back, I think it was like 20% in the second quarter, and it sounds like that's the bottom. So not only are good unemployment numbers coming out the pike tomorrow, starting today, I think ADP reports today. Tomorrow will be the BLS numbers for June, and it looks like we have a record number of jobs created. Now, look, we all know that's it's all numbers, but still, you always want better numbers than worse. That's a fact. Better numbers show growth, and we want growth. I mean, even though we're starting from a manufactured bottom, well, still, hey, man, we still want to go up as opposed to down. Dividends only being cut 20% as opposed to, what are they saying? A lot more than that, 80% or something like that. That's huge, man. I tell you, the dividends are one of the surest ways to gauge a company's strength. When they're cutting dividends, that means they're reserving cash flow. And a lot of times it also means they can't take debt either. And that, you look at GE. Look, I got no idea what GE's debt structure is. I just don't know. But they cut their dividend. I imagine they're still borrowing like drunken infantrymen. But not having any dividend payout, whereas GE still got like a 0.8% yield. I can't remember. But anyway, cutting a dividend is a sure sign that corporations are trying to save cash. All right. Now, the scary thing that bothers me with some of these companies is if they're not cutting dividends and yet they're cutting salaries. I read a headline. I didn't read the whole article on that. And that could just be some left-wing clickbait. I don't know. I find that to be basically reprehensible. If they're cutting salaries and while they're not cutting dividends, that's not good. That's not good. And again, I saw some headline on that. I didn't read the article, but that's not a good sign if that's what's happening because employees should, I hate to say it, shareholders own the company. All right, that's a fact. Employees are also shareholders a lot of times. All right, so if you're cutting a salary back, but the salary is what puts food on the table for the employees. So if you're cutting salaries and you're keeping your dividend, I just think that shows you there's not an equal priority between labor and investors. And that's not good for morale. That's not good for future labor growth, that's for sure. It actually might get a boost by share price because when people are cutting back dividends, when people are cutting salaries, they're reducing labor costs, which means short-term profits could go up. But the problem with that is that leads to less retention of employees, less morale, and ultimately that's not good for the labor force and ultimately won't be good for the price because people start saying this company isn't looking out for me, so why would I look out for it? And that's not good. Losing employees, low retention, low morale is not good for the bottom line. It just is not. Any manager will know that. Efficiency, productivity is the number one thing with employee. You're paying somebody, let's say $10 an hour, or you're getting $20 an hour of labor from that $10 an hour. So it's cost you 10. I just use that for number, but you're getting 20 back. So you're basically getting a $10 profit in that cost. Actually, it's a lot. It's not nearly as easy as that. You're probably paying somebody 10, you get 13 back, $3 a profit, because labor is about 70% of a corporation's total expenditures for sure. Anyway, so what happens is you're paying somebody 10, you get $13 back in revenue. Well, when you're hiring somebody new, you might be paying him 8 or 9, but you're not getting even 8 or 9 back. You're getting less because they're not productive. They have no productivity because they don't know the job, and it takes time to settle in. And so when corporations start losing employees because of low retention rates, inherently their productivity goes down. Now, investors, they just see the short term. They say, oh man, labor costs going down. That's a good sign. That's idiotic, man. That's idiotic. And that's the problem with corporate America. Everything's contingent on quarterly reports, which is stupid. Trump tried to stop that, and he got stopped. He wanted to make it annual reporting to the SEC as opposed to quarterly. I don't know who stopped it, but they did. And that's not good, because the quarterly reports are short-term investments. And short-term investments, you can literally, I mean, like ROI, return on investment. You want to make a short-term investment windfall? Take on a hell of a lot of debt. You can increase your ROI like crazy just by being overly leveraged. Make a short-term boon to the corporation in terms of, I guess you could say profitability, but certainly ROI. All right, so now your marketing officer will sell to say to mutual investors, mutual funds, pensions, and whatnot, hey, look, you invested $10, you got $40 back, a 400% ROI. And the investors say, whoa, I'm buying that. Huge corporate bump in share price. How did you get it? From being leveraged to the hilt. Leverage will always come back to bite you. Anyway, so good news. We'll see how it shakes out, but we'll take the good news when we can get it. All right, we'll see you.